Warren Buffett, a man who has famously said that tech companies are well outside his circle of competence, has just bought into one of the biggest tech companies in the world. In fact, this is a Magnificent Seven company. I can tell you that certainly was not on my 2025 bingo card, but here we are. Just a few days ago, Buffett released Berkshire Hathaway's 13F filing, and slotting into the 10th largest position is a brand new buy in Google. Yes, Berkshire bought 17.8 million shares in the tech giant worth around $4.3 billion. This is a very interesting move, and I'll tell you why. Buffett, as we know, loves investing in companies with very wide moats. It's a cornerstone to his investment approach. You think Apple, Coca-Cola, Visa, MasterCard, etc. But one topic that has been under very hot debate amongst value investors over the past few years is whether Google is in fact losing its big monopoly in search. We know that Google, or technically Alphabet, is a company that for the longest time has consistently captured literally 90+% of internet search queries worldwide. And this has more or less powered the stock for the better part of 2 decades. But the question being argued by investors now is whether this once untouchable moat is being disrupted by large language models like ChatGPT and Perplexity, Claude by Anthropic, the list goes on. And this has led to speculation that Google stock, that's basically gone vertical in the last 12 months, is getting a little bit out of hand. So this is a very, very interesting move by Buffett. And in this video, I want to show you why he's done it, why he's backed Google despite all of the, very legitimate concerns around ChatGPT and other LLMs. The interesting thing about this situation is the magnitude and pace of potential disruption. For context, we know Google has been the search behemoth for decades, and before the release of ChatGPT, it honestly looked like nothing would ever be able to topple this moat they had in search. As I noted, for over a decade, Google had maintained its over 90% share in internet search, with the next closest competitor being Bing at around 4%. Now, that is one of the biggest monopolies I have ever seen, but since November 2022, things have really changed. That was, of course, when ChatGPT was released, and since then, Google's world has been shaken upside down. ChatGPT reached 100 million users in just 2 months, making it the fastest growing consumer application of all time. And research from Bain & Company shows that 80% of consumers now rely on zero-click results in at least 40% of their searches. So more or less 40% of the time, consumers are now turning to LLMs like ChatGPT to do the job that they used to get Google to do. Now, while that's hardly a dominant statistic like Google's 90% market share, it does show that people are turning to LLMs more and more. Why? Well, because they don't need to click on anything. They get spoon-fed an answer that's usually thorough enough for their needs. Now, this flies directly in the face of Google's advertising model, where they need people to click on links in order to charge advertisers. Now, this is a really big deal. It's a very small change, but it's a really big deal. The language of search is now changing from search to ask. But the question is this eroding Google's moat? And does this mean the stock is becoming a big bubble? Well, at a theoretical level, it sounds like Google's moat is being challenged, but I want to look more into the financial data to really properly explore this idea. And when you do, you quickly get a bit of a reality check because the numbers tell a much different story. If we turn over to Seeking Alpha, we can see that as of December 2022, when ChatGPT was released, Google's annual revenue stood at $283 billion. Their operating income was $75 billion. Now, that gives them an operating margin of 26%, meaning if they made $100, they keep 26 for themselves before interest and taxes are factored in. Now, in the last 12 months, Google have generated a whopping $385 billion in revenue and kept $126 billion as operating income, i.e. an operating margin of around 32%. So in the last few years, Google have not only grown revenue, but increased their margins. And that is a very, very strong signal that a business's moat is strengthening, not weakening. But what about if we look at search in particular? In Q3 of 2022, Google reported search revenue of $39.5 billion, but fast forward to Q3 2025, they're raking in $56.6 billion. So quarterly search revenue has actually increased 43% in the last 3 years. That is not a sign that Google is losing their moat. In fact, if you took away the narrative and this was just any random company, you would actually conclude that this business's moat is getting stronger. And you might say, wait up, Brandon, revenue is one thing, show us profit. Now, unfortunately, Google doesn't tease out search into its own line when we're talking about segment operating income, but still, Google services, which includes YouTube ads and Google network ads, the Google banners and whatnot that appear on other people's websites, Google services operating income has grown from 19.78 billion in Q3 of 2022 to 33.53 billion in the most recent quarter. That's a 69.5% increase in profitability of the segment in 3 years. That is definitely not a sign that Google is losing their moat. And by the way, before we continue, I just want to give a massive shout out to Seeking Alpha, who were instrumental in the making of this video. I've been regularly using Seeking Alpha Premium for years at this point, and the reason why is because of the depth of research I can go into on the platform. For example, you can get 10 years worth of financial data. You can also check out a range of valuation metrics, which is really useful to make sure you don't overlook anything in your process. You also get the Seeking Alpha rating system there as a fallback to make sure you're not missing things. As you can see on this page, you get the rating summary from Wall Street analysts and also Seeking Alpha's own proprietary system, plus factor grades for valuation, growth, profitability, etc. Then on top of that, you get unlimited access to news and analysis articles, which as you can see, even cover the topics I'm talking about in this very video. It's a really great resource, and they're currently having a massive Black Friday sale where you can score 20% off of Seeking Alpha Premium. I definitely recommend it. It's one of the few subscriptions that I actually use all the time as an investor. And the best bit is you can even try it for 7 days completely free to test it out. They also have Alpha Picks at a 20% discount if you're interested in more of the investing ideas, or bundling the two subscriptions together will get you the best value possible, where you end up with around a 28% discount. So if you want to, you can use my link in the description or pinned comment or scan the QR code on screen to get those discounts. And once again, thank you to Seeking Alpha for sponsoring the channel. But back to Google. So what's the story? Well, there is certainly the narrative that Google's moat is under threat, but so far, as we're talking about, the numbers just don't support that theory. And this honestly continues into the cash flow statement, and it continues into the balance sheet as well. Going back to Seeking Alpha again, you can see that in terms of free cash flow, Google has not at all been troubled, at least thus far, by competition, as it's actually been able to grow free cash flow per share to $6.05 in the last 12 months versus $4.59 in 2022, the year before ChatGPT is released. Free cash flow can essentially be thought of as the money the business makes for the owners at the end of the year. Value investors absolutely love to look at this metric, and declining free cash flow is a good sign that the cash producing abilities of the company are on the decline, or they may be investing heavily in the business to try and unlock the next wave of future cash flow generation. So they're really the metrics you can look at to tell you about a company's moat. But another thing you can also look at is whether you're seeing the financial health of the company erode over time. For example, are they whittling down their cash reserves, or potentially taking on a lot more debt to be able to keep up with the competition? And in Google's case, they continue to be a financial fortress. Get this, they have roughly $100 billion of cash sitting on the sidelines or invested in short-term treasuries, and just $26.6 billion in total debt. So they could pay off almost their entire debt balance tomorrow if they wanted to, just out of cash. And then they'd still have around $70 billion of short-term treasuries left over. So this business is definitely rock solid financially, and while the balance sheet doesn't give you direct insight into the moat, definitely shows you whether the business could hold up if the moat started to get challenged. So that's very much the Google side of the lens, but next up, I want to talk about the ChatGPT side, the challenger, because as an investor, you definitely don't want to dismiss the idea of a disruptor when there's a decent theory behind it. But here's the thing. OpenAI, the company behind ChatGPT, is a long, long way off being able to properly threaten Google's moat properly. And this is because they don't actually make any money. For example, it's estimated that the company has hit an annualized revenue run rate of $12 billion, but as we've been talking about, revenue is not the same as profit. In fact, the business is expected to burn $115 billion through 2029. That is roughly $80 billion higher than earlier forecasts, and an absolutely staggering number compared to their revenue. It just shows how costly it is to run and scale these large language models. When you compare that to Google, which is producing around $70 billion in free cash flow every year, really puts into perspective how one business is printing money while the other is burning it at a very intense rate just to keep up. Now, sure, OpenAI does have the backing of Microsoft, but just goes to show you the difference in the position of these two companies. And what does that ultimately mean? It means that Google has both the time and the resources to flex its muscles and play catch up. We can already see the beginnings of this happening in the current Google search we use today. Where relevant, Gemini springs into action, giving you a ChatGPT-like result. And as we speak, Google is busy putting enormous resources behind this area of their business to ensure they're right in the mix moving forward. So with that said, what does this mean? Well, this whole debate is really a perfect reminder of just how important a moat is in investing. To be clear, you never want to get complacent when holding a stock. You never want to fall into confirmation bias or ignore technologies that could pose a threat. You always want to be looking to invert your thesis, asking what would have to be true for this company to fall. But in this case, the data shows something pretty remarkable. Despite all the noise, all the flashy headlines around AI disruption, all the speculation that Google is done for, the business has never been stronger. Revenue is up, margins are up, free cash flow is up, and their balance sheet looks like a financial fortress. And this, I think, is what Warren Buffett sees. There is no financial evidence that their moat is being challenged. In fact, it seems to be getting stronger over time. You couple that with a rock solid balance sheet, and you have a situation that follows Buffett's first rule of investing. Rule number one, don't lose money. But here's the other interesting piece, the valuation. Google stock isn't the cheapest, it has a PE around 27. Remember, when Buffett bought into Apple, it had a PE ratio around 16. So why has Buffett bought in now? Well, this is an example of Buffett paying a fair price for a wonderful company as opposed to looking for a fair company at a wonderful price. The other thing to remember as well is that Buffett is very much limited by size. He's looking to invest billions of dollars, if not tens of billions of dollars at any given time. And because he likes to stay under 10% ownership in these companies, that naturally limits the number of companies that can even shift the needle for Berkshire. So yes, while there might be some cheaper, high quality small caps out there that might promise much better returns than a fairly pricey Google, ultimately Buffett simply can't deploy enough capital in these sorts of businesses for them to be worth his while. And in all honesty, it's the generally overvalued nature of the stock markets today, plus the size factor, that has led Buffett to say that these days, Berkshire has no possibility of eye-popping performance. So I don't necessarily think Buffett is running around treating this like a smack bang home run. I think he probably is just viewing it as a decent investment that's just better than cash or US treasuries. So that's my take, but honestly, I would really like to hear yours as well. Please drop that stuff down in the comment section below. And as well, leave a like on the video if you made it this far. Once again, check out Seeking Alpha if you're interested in those Black Friday deals. More of that can always be found in the description and the pinned comment. But with that said, thank you all very much for watching, and I'll see you guys in the next video.